Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, we're diving straight into what is one of the most intellectually jarring paradoxes in the small cap market today. Society Pass, or SOPA. This is a company with a market cap that, hovers around $7 to $10 million, yet it holds a controlling interest in a separate NASDAQ-listed subsidiary, Nucitrip and UTR, which is valued on paper at well over $170 million.
Right.
So the central question for any sophisticated investor is it's inescapable. How does a parent company trade at what is effectively a negative enterprise value when you compare it to its most significant, most liquid asset? Is this a fundamental disconnect, or is it, a structural trap designed to prevent price discovery?
That valuation gap you're describing, it is staggering, and that's what draws all the attention. But the persistence of this gap, the fact that this arbitrage has existed for so long, it suggests the market is pricing in risk factors that go far deeper than simple arithmetic. I mean, we don't just have stability here. We have this acute volatility that confirms these underlying struggles. Take the recent price action. The stock's currently trading around, what, 195? We saw a powerful double-digit rally, 16.19% on December 18th, driven by that Ascendiant Capital price target of 2250. That's a 1,700% theoretical upside. And yet that gain just immediately evaporated. It was followed by a steep 12.3% drop on December 19th. The market simply cannot sustain gains, and I'd argue that structural impediments are actively overriding any theoretical sum of the parts analysis.
And that's where we disagree. I'm representing the position that this is mathematically indefensible. I believe the valuation gap is driven purely by the arbitrage opportunity in that NUTR stake. My position is that the theoretical upside, that 1,700%, is the only rational metric, and this dislocation, it has to resolve eventually.
And I'll present the alternative view. I hold that specific structural forces, namely dilution risk, these opaque financing flows, and market microstructure, are the genuine, determining factors of the current price, regardless of the theoretical asset base.
All right, let's start with the basics. The stock is mathematically broken. When Ascendiant Capital assigned their 2250 price target, they were simply applying a rational valuation based almost entirely on the NUTR position. When you look at NUTR's market valuation, SOPA's stake alone represents approximately $20 per share for the parent company.
Okay.
What that means practically is profound. The market is currently assigning a massive, just a staggering negative value to all of SOPA's remaining legacy assets and operations. Their e-commerce platforms, their digital marketing, their new AI initiative. It's pricing those things at less than zero. This isn't just value investing, this is deep value arbitrage. The retail thesis you sometimes see on places like Wall Street Bets. It views the sub-$2 price as a glitch in the matrix, and based purely on the balance sheet, that view is fundamentally supported by the numbers.
I acknowledge the staggering mathematical dislocation. I mean, it's undeniable. But I'm not convinced by that line of reasoning because you have to ask why the market, which we both agree is ultimately a weighing machine, has allowed this dislocation to persist for so long. It's because the market is pricing in the reality of execution risk and, critically, the capital structure realities. I mean, we just can't ignore the history of share destruction here. They executed a devastating 1-for-15 reverse stock split in May 2024. That wasn't some strategic move. That was purely a survival mechanism, required to keep the big price above the necessary $1 minimum for NASDAQ compliance. That action, fundamentally, it signals acute financial distress. It's survival mode, which is the exact antithesis of deep value.
Sure, but...
And just look at the immediate market reaction to their recent corporate strategy, the December 2025 AI pivot, which was designed to ride this secular tech boom, was met with massive selling. Why? Because the associated S-1 filing, the SEC registration for new shares, signaled acute dilution. That $3 million equity offering effectively meant existing shareholders would see their stake shrink by nearly 37%. The resulting 13.16% intraday drop shows the market isn't just skeptical, it's pricing in the inevitable, expensive cost of funding that ambition. The current price isn't a glitch, it's a cold, hard calculation of dilution risk.
I understand the skepticism, I do, especially around past capital maneuvers. But that narrative ignores the proof of concept. Let's press on the core asset value and the NUTR blueprint. SOPA's strategy of acquiring undervalued assets and transforming them is proven. I mean, they acquired NUTR for under $5 million back in August of 2022 and successfully listed it at a valuation that soared past $170 million. The high price targets are justified because the underlying ability to create and accrete substantial asset value is, well, it's validated.
But is it repeatable?
And furthermore, despite the ongoing cash burn, they reported $14.91 billion in cash and current investments as of Q3 2025. Now, while cash consumption is a concern, they have a modest runway, and the theoretical intrinsic value remains sound based on the successful incubation and spin-off they've already executed. If they can replicate that success even once, the current valuation is it's ludicrously low.
I'm sorry, but I just don't buy that the cash runway is sufficient, especially when you contrast it with the monumental requirements of a new, capital-intensive AI infrastructure strategy. You're relying on the value of the NUTR stake, but that is for all intents and purposes paper wealth. Investors aren't ignoring the value, they're pricing in a massive holding company discount that's compounded by intense governance risk.
Okay, but
Let's be very clear about the illiquidity. SOPA cannot, in practice, liquidate its $100 million plus NUTR stake. If they tried to sell a significant fraction, they would instantly crash NUTR's stock price, which would just annihilate the remaining value. It's illiquid collateral. And critically, management's past behavior confirms the fear that this paper wealth will never reach the shareholders. They have a history of using capital to fund operational expenses and cover massive cash burn. Q3 2025 alone showed a net loss of 89 cents per share and a staggering 42.5% revenue miss. The cash position dropped by $1.67 million in that single quarter. The prevailing and I think logical fear is that the NUTR value is just an ATM, constantly being drawn down to prop up failed ventures or pay executives, rather than being returned to the parent company's shareholders.
That point about cash burn is critical, and I acknowledge the negative trend, but I would frame the market's reaction differently. The current valuation implies zero possibility of any future strategic action succeeding. It implies they can't execute a partial distribution of the Nutra stake, a dividend in kind, or a full spin-off of a new AI vertical. That is an overly punitive, near-zero assessment of management's capability. The successful Nutra listing shows they can execute complex financial maneuvers. The market is currently giving them zero credit for replicating that blueprint with any future AI assets. That kind of profound skepticism in the face of demonstrable asset creation is what defines the arbitrage opportunity. We're betting that the market is wrong about their ability to monetize assets that are already on the balance sheet.
Your point about potential monetization is fair, but it leads us perfectly into the mechanics of why positive news, like that Ascendiant target, fails to stick. It brings up the issue of dark pools and structural selling pressure. This, to me, is the definitive impediment. Why do rallies fail so quickly? Because of overwhelming off-exchange trading. We have data confirming the off-exchange short volume ratio was reported as high as 54.98% in late 2025. I mean, think about that. More than half the trading volume is routed off the lit exchanges, deliberately preventing genuine sustained price discovery. This isn't a conspiracy. This is just finance structure in action. And this high off-exchange volume is often symptomatic of what's called toxic financing. When a financially stressed company like SOPA issues convertible debt or other highly dilutive instruments, the lender gets shares at a deep discount, creating a guaranteed profit. To lock in this risk-free arbitrage, they immediately sell those shares. But to avoid crashing the stock on the public market, they use dark pools and algorithms to just drip-feed large volumes of sell orders. This creates a perpetual shadow inventory. So when the Ascendiant news hit and retail buyers pushed the stock up 16%, that shadow inventory was immediately deployed. The consistent structural selling pressure instantly absorbed all the buying, forcing that 12% reversion the very next day. This constant structural ceiling, fueled by financing, is why the stock price is where it is.
I see why you emphasize that data, but I think you're misinterpreting the causality there. That high volume doesn't necessarily prove structural suppression aimed at keeping the price down. It just proves velocity and high-frequency trading. You're conflating high short volume with structural short interest. We have to look at the official data. The official short interest is extremely low, only around 70,000 shares as of late November, which results in a negligible 0.03 days to cover. This completely debunks the idea of a massive, trapped, long-term short bet by bears. If structural bears truly believed the company was worthless, they'd be massively short and the days to cover would be high. That high short volume just confirms transactional, high-frequency market making. It means liquidity providers are hedging retail buys. They're shorting and covering almost instantly. The high-frequency desk is simply flipping inventory fast, which results in choppiness and volatility, not some structural bear ambush.
The high-frequency desk is simply flipping inventory fast, which results in choppiness and volatility, not some structural bear ambush. I respect the distinction between volume and interest, I do, but the high-short volume is the relevant metric for price discovery. Whether the selling originates from a long-term bear or a high-frequency trading desk hedging convertible debt, it's irrelevant to the public shareholder. The effect is identical, a perpetual ceiling that prevents any sustainable price gains. These dark pool activities and high-frequency sellers ensure that the path to the $1.41 resistance, the 200-day moving average, remains definitively blocked. And this is the crucial psychological and technical line for institutional money. As long as SOPA cannot sustainably close above that 200-day average, institutional traders will continue to treat it as fundamentally bearish, regardless of the theoretical asset value in NUTR. The technicals confirm the structural narrative.
Okay, let's shift focus to the future, to the ambition of the company, because that is where the potential for a re-rating lies. The December 2025 AI pivot is a necessary and ambitious move. It's an attempt to capture the massive secular AI boom, and crucially, it aims to replicate the successful NUTR strategy. If they can build or acquire an AI asset and eventually spin it off or list it separately, that shift could fundamentally break this established bearish trend and re-rate the entire holding company. This is a credible path to unlocking that underlying value.
And I'm just not convinced by that line of reasoning because it drastically underestimates the CapEx and the execution risk. Building network infrastructure, the core of this AI pivot, is intensely capital intensive. It requires massive investment in data centers, heavy equipment, specialized personnel. This is so different from their existing e-commerce platforms, and it conflicts entirely with the company's documented inability to manage cash. For a company defined by cash burn, a negative $1.67 million change in cash in Q3, this grand ambition immediately translates into investor fear. The market's reaction, that 13.16% drop, it reflected a logical conclusion. This ambition will require even more dilutive equity issuance, confirming the death spiral financing pattern that has plagued SOPA since the reverse split. Management's vision requires capital they simply do not have, without destroying existing shareholder value through relentless dilution.
Yes, but if they execute the AI pivot with the same finesse they showed with NUTR, taking a minimal investment and transforming it into a separately listed, high-value entity, then that initial capital risk is absolutely worth the reward. The market is judging the AI strategy based on the company's legacy financial issues, not its demonstrated ability to create subsidiary value. That lack of faith in management's strategic capabilities is precisely what creates this multi-bagger opportunity.
The problem is the market has seen this film before. The successful NUTR spinoff was the exception, and the history of the core business is the rule. The company's persistent financial instability means every single dollar of that NUTR paper value is inherently discounted because it's seen as the only available financing tool for a capital-hungry new vertical. The structural impediments ensure that the asset value is kept by the liability of its perpetual need for cash.
I still maintain my core position. SOPA remains a deeply speculative but mathematically compelling opportunity. For investors willing to tolerate the extreme volatility, this is a clear bet on a forced closure of that arbitrage gap. The high short volume may not be a traditional short squeeze, but the dormant potential for a rally driven by the undeniable valuation disparity and that aggressive analyst target remains a powerful catalyst just waiting to activate momentum buyers. The value's there, even if the timing is uncertain and the corporate structure is complex.
And my position remains focused on the reality of the price action. The valuation is not governed by theoretical paper assets or analyst fantasy. It's governed by the undeniable evidence of structural dilution confirmed by that May 2024 reverse split, by toxic financing flows evidenced by the nearly 55% dark pool volume, and by the massive cash-intensive execution risk of their new AI strategy. The market is acting rationally by applying a deep holding company discount to assets that are structurally inaccessible and are likely to be consumed by operational necessity.
That's an interesting point, though. I would frame it differently. The risk is the price of the potential reward.
Indeed.
Ultimately, the valuation of Society Pass hinges entirely on whether one views it as an asset-rich company temporarily suppressed by market mechanics, just waiting for a catalyst to close that $20 per share arbitrage, or as a financing vehicle whose fundamental assets are perpetually capped and destroyed by structural liabilities and unending necessary dilution.
The material provides compelling evidence for both credible positions. In the final assessment of whether this stock represents a glitch in the matrix or a toxic financing vehicle, as always, is left to the sophisticated listener.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.